Imagine logging into your investment account one morning and discovering that the money you trusted a financial company to protect may not actually be there. Not because of a market crash, not because of a global recession, and not because of a sophisticated cyber attack. Instead, the problem began inside the company itself. For nearly 2 decades, one businessman managed to convince customers, auditors, regulators, and even banks that everything was operating normally. His company appeared successful, its offices looked professional, its records seemed legitimate, and year after year, inspections failed to uncover the truth. But behind the scenes, a hidden financial gap continued growing. What began as a small problem eventually became a hole worth hundreds of millions of dollars. When the truth finally emerged in 2012, it stunned the financial industry and raised serious questions about oversight, trust, and accountability. This is the story of Russell Wasendorf Sr., founder of Peregrine Financial Group, and how one of the longest-running financial deceptions in modern American history managed to remain hidden for nearly 20 years. To understand how this happened, we need to go back to the beginning. In 1980, Russell Wasendorf Sr. founded Peregrine Financial Group, often known as PFG. Unlike many financial firms headquartered in New York or Chicago, Peregrine operated from Cedar Falls, Iowa. That unusual location helped shape the company's image. PFG wasn't viewed as a flashy Wall Street operation. Instead, it presented itself as a disciplined, customer-focused financial firm, serving investors across the country. The company specialized in futures trading. Clients trusted PFG with funds used to trade commodities, currencies, and financial instruments. Over time, the business expanded significantly. New customers joined. Revenue increased. The company built a larger headquarters. Employees viewed the future with optimism. To many observers, Wasendorf represented the classic self-made entrepreneur. He appeared confident, ambitious, and dedicated to growing his business. As the years passed, his reputation continued to strengthen. Few people suspected that a serious problem was developing behind closed doors. The first deception. According to later investigations, the deception began years before anyone outside the company became aware of it. At some point, customer funds that should have been available in segregated accounts were no longer fully there. For many business leaders, discovering a financial shortfall would trigger difficult conversations, restructuring plans. But investigators say Wasendorf chose a different path. Instead of addressing the problem openly, he allegedly began creating false documents. Those documents made it appear that customer funds remained safely held in bank accounts. At first, the discrepancy was relatively small, but maintaining the deception required additional false records. As time passed, the gap between reality and what appeared on paper continued to grow. The larger the gap became, the more difficult it was to reverse course. What may have started as an attempt to solve a temporary problem gradually evolved into a system that depended on constant concealment. And for years, nobody realized what was happening, how the system was fooled. One of the most remarkable aspects of this case is not simply that the deception occurred, it's how long it lasted. Financial firms operate under extensive oversight. Regulators review records. Auditors verify information. Banks maintain account balances. Multiple layers of review are designed to protect customers. So, how did one individual avoid detection for nearly 20 years? According to investigators, a key weakness involved bank confirmations. Normally, regulators and auditors verify account balances directly with banks. That independent confirmation serves as an important safeguard. But investigators later discovered that false confirmation documents had allegedly been provided instead. Those documents appeared authentic. The balances looked correct. And because the paperwork matched expectations, the system largely accepted the information as accurate. Year after year, inspections continued. Year after year, the illusion survived. The case would later become a powerful example of how important independent verification can be. A growing problem. As the years passed, maintaining the deception became increasingly difficult. Imagine trying to balance a checkbook while hiding a growing deficit. The larger the discrepancy becomes, the more complicated every future transaction appears. That is essentially what happened at PFG. The missing funds continued growing. More documentation was required. More explanations became became necessary. The operation increasingly depended on keeping the underlying problem hidden. Yet from the outside, the company appeared healthy. Employees continued performing their jobs. Customers continued investing. Business continued as usual. Few people realized that the financial foundation beneath the company was becoming increasingly unstable. By the late 2000s, the situation had evolved into a massive problem: the collapse. By 2012, improvements in oversight and verification procedures created new challenges. Technology was changing. Financial reviews were becoming more sophisticated. Regulators increasingly relied on direct verification methods. The environment that had allowed the deception to survive for years was becoming less forgiving. Then came the moment that changed everything. Investigators began examining customer account balances more closely. What they found was alarming. Funds that were supposed to exist simply were not there. The estimated shortfall exceeded $200 million. The discovery sent shockwaves throughout the industry. Customers were stunned. Employees were caught completely off guard. Regulators rushed to determine how such a large discrepancy had remained hidden for so long. Within days, confidence in the company collapsed. Years of trust disappeared almost overnight. The consequences were immediate. Peregrine Financial Group entered bankruptcy. Customers faced uncertainty regarding their accounts. Employees found themselves working for a company whose future had suddenly become unclear. The case attracted national attention. Industry experts began examining what had happened and why existing safeguards had failed. The questions were difficult. How could regulators miss such a significant issue? Were verification procedures strong enough? Could similar vulnerabilities exist elsewhere? In response, regulatory agencies reviewed their processes. Verification standards became stronger. Independent confirmations received greater emphasis. The case became an important lesson in financial oversight and risk management. Conclusion: the story of Russell Wasendorf Sr. remains significant because it extends beyond numbers and balance sheets. At its core, it is a story about trust. Customers trusted a company. Employees trusted leadership. Regulators trusted documentation. And for years, that trust appeared justified. But trust without verification can create vulnerabilities. The collapse of Peregrine Financial Group demonstrated how a carefully maintained illusion can survive far longer than many people imagine. It also showed why transparency, accountability, and independent oversight remain essential parts of the financial system. Nearly 20 years after the deception began, the truth finally emerged. And when it did, it transformed a respected business success story into one of the most discussed financial scandals in modern American history.